Welcome back to the Sense of Security podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers, and today I'm your host for the podcast. Our guest is Robert Reed, Senior Equity Analyst from Briefing.com. In this episode, we are going to explore dividends. There are many layers to this topic, such as types, distribution, and more. In this conversation, we look to explain the foundational concepts for those looking to learn more about dividends and potentially adding them to their investment strategy. Welcome to the program, Robert.
Oh, thank you so much for having me.
Sure. So, for our first question here, because it's your first episode with us, why don't you tell the listeners a little bit about your background in the industry and how you got started?
Sure. So it's funny, actually, I started with a company called Solomon Smith Barney for Citigroup. On the sell side, we were doing research for steel companies. That's kind of where I got my start. Did that for about 2 years. I was also briefly on the buy side. And then probably the last 20, close to 25 years now, I've been with Briefing.com doing equity analysis. Mostly, I focus more on fundamentals and buy and hold type investments. We do have like technical analysts, but my expertise is more on the, you know, digging into the fundamentals, looking at income statements, balance sheets, that kind of thing. So I'm more of a buy and hold type analyst.
Got it.
And just real quickly, at briefings, I'm in charge of the emerging growth stocks report, and we also publish a value leaders report and a yield leaders report too that I work on.
Cool. So, just to get into the meat and potatoes, if you will, of the podcast. So, we're going to talk about dividends today. So, when we're starting out in the topic, what exactly is a dividend? Are there different kinds? Are they paid out certain ways?
So a dividend is basically a company rewarding its shareholders, usually with cash. So, for example, let's say you have a stock trading at $100 a share. If it has a 3% yield, that means throughout that year, it's paying about 3% of the value of the stock out in cash. Of course, the stock will go up or down over time, so the yield will change from day to day. But generally, companies every quarter they'll give out a cash payment to shareholders. It's kind of just a way to allow investors to benefit from these investments without selling the stock. So if they want to, just throw off some cash to people, and that way people can use this money to either live on or maybe reinvest it in something else or reinvest in the company, they can do it that way. So just to kind of explain sort of the nuts and bolts a little bit. So you know, dividends are not required to be paid by a company, but a lot of times they do just because they attract people looking for an income yield. And the way it works is, let's say there's an ex dividend date, and then the dividends are usually paid out after that. So usually, if you own the stock before the ex dividend date, then you receive that quarter's dividend. But if you hold it on the X date and beyond, then you do not get paid the dividend. So that's something to be careful of. People need to keep an eye out for. So there's cash dividends. There's also stock dividends. A lot of times this happens when a company does a stock split. So if, for example, Palo Alto Networks last week, they did a 2-for-1 stock split. So those shareholders got a stock dividend when the stock split that they could just put into their portfolio. But for the most part, it's cash dividends are the typical ones. And there's also something called special dividends. And these are they're not regular. A company will just give a special, like let's say if they've earned a lot of cash in a particular quarter or a particular 6 months, they might just, give out a special dividend, which is like a one-time, maybe $1 a share. It's usually larger than the typical quarterly cash dividends, but it's another way of rewarding investors for, especially long-term investors, for buying and holding their stock. And again, the ex-dividend day is something very important to keep an eye on, especially for special dividends, which are larger. A lot of times you'll see the stock drop on the ex-dividend date because the value of the share of the security goes down once the dividend gets paid out.
Yeah, totally. I mean, there's obviously different categories, I guess we can say, that they go in.
Mhm.
And there's a difference in, we'll say, the size or the
Mhm.
timing of it. But when we talk about them in terms of special dividends, cash, stocks, some people may initially think that sounds great. Why didn't I get a dividend on X stock or B
Mhm.
stock that I have? So, in a general sense, do all stocks get a dividend? And who decides if they even get them and why?
All stocks do not get a dividend. In fact, quite a lot of stocks do not. So the board of directors, they decide, they do a vote on whether or not a company should be doing a dividend. So it's usually up to the board of directors to make that decision. And it's basically companies that are geared more towards growth, and they may not even be profitable, but companies that just want to grow, 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 they tend to not even pay dividends. It's generally like larger companies that generate a lot of cash. they want to just reward their long-term shareholders with money. If you are looking for an income, make sure that you check the dividend to see if it's something that you're interested in.
So you had mentioned in the previous question talking about maybe the size or the one time only almost dividends, and that kind of leads into, are they growth, are they value? How are they looking to apply this capital with their business to their
Mhm.
holders? How exactly would taxes be applied to dividends? I mean, you don't have to go into it like an accountant, but
Mhm.
how would they be applied in a general sense?
What it really comes down to is how long you've owned the stock. So there are two types of dividends in terms for tax purposes. There's qualified and non-qualified. Qualified dividends have a lower tax rate, usually at 0 or 15 or 20%, but you have to hold the stock for 60 days before the ex-dividend date and I think 60 days after. So they're generally more for longer term holders of the stock. So you get that lower tax rate. For non-qualified dividends, you just pay at the ordinary income tax rate. I think that what the idea is there, they don't want people like short-term investors coming in 2 days before the ex-dividend date, getting the dividend, and then selling the stock 3 days later. So they would receive that dividend, but they're not long-term holders of the stock. So the IRS doesn't want to reward them with a lower tax bracket just because they come in for 3 days and buy the stock and leave. So that's generally why they do that. Is for long-term holders, they get the lower tax rate.
So initially, I guess people who are looking to incorporate dividends into their strategy, they may hear everything you're saying and be like, well, generally it sounds great. I get some extra cash or items, if you will, in my portfolio if they go stock. What would be the pros and cons to the argument of dividends? Like, is it always considered a good thing or is it something that, needs to be looked at with a critical eye?
I think it needs to be looked at with a critical eye. I mean, if you're looking for a high growth investment, then dividends are not really going to be that important. Dividends are more for if you want to hold a stock, but you don't have to sell the stock to generate some cash out of your investment. So it kind of depends what kind of investment you're looking at. If you're looking for like a growth company or even like a biotech stock, they may not even earn any money. They're probably not profitable, but they might get an FDA approval on some drug down the road. You're not going to get any dividends from that, but they might turn out to be a great investment if everything turns out well. And a lot of tech stocks, especially smaller ones, don't pay a dividend. Again, those companies, they take whatever money they do earn and they reinvest it back into the business. Maybe that means hiring more salespeople. Maybe that means building out their data centers or trying to get more customers. And they're not as worried about paying shareholders. They know shareholders will eventually be rewarded with the appreciation in the stock over the long term. So it just kind of depends what you're looking for. But a lot of people who do want that income, especially like older investors do, where, maybe they're not working, but they want to collect some cash. They can look for a high income stock that won't be as aggressive as a tech stock, for example, but it will, spin off maybe 5, 6% every year. And that's good enough for a lot of people. Like a lot of utilities are attractive to those type of investors where the stock doesn't really go up or down very much, but it does kick out, a 5 to 7% dividend which people can use without having to sell the stock and get hit with, a capital gain. Just kind of depends what the investor is looking for.
So let's say somebody is looking to incorporate dividends into their financial strategy or dividend paying stocks into their
Mhm.
portfolio. What are some things that they should keep in mind as they start to weave it in? I mean, are there ratios? Are there yields to pay attention to? Disadvantages? There's so much research out there. Sometimes it's hard to boil it down.
Yeah, it just kind of depends. What you like to do, especially if you're a buy and hold investor, basically you want a company that just consistently raises the dividend every single year. Then you know that dividend is safe and it generates good cash over time. But it really just kind of depends what you're looking for. If you're more of a growth person, you probably should even just ignore dividends. But if you kind of want some of that income, then it would be important to look at. Kind of a strategy that I like to do is kind of look for maybe beaten down names that are just kind of out of favor, but they pay a good dividend, so the yield is very high. For example, like a Whirlpool. The housing market is kind of slow right now because nobody's moving because they don't want to give up their 3% mortgage. But eventually, if rates do come down, and let's say people start moving again, they start selling their house, buying a new house. A stock like Whirlpool might be interesting because it pays about a 5.8% dividend and it has that turnaround, hopefully capital appreciation value as well. That's kind of like threading the needle where you get both, where you get the nice dividend, plus you also get the hopefully capital appreciation. I like to look for beaten down markets or beaten down stocks that do pay a good dividend, that turn themselves around when the market gets better. So those are the kind of things that I look for.
So, I guess my final question would be, you had mentioned a few different labels kind of for the stocks that we've been talking about in generalities, whether
Mhm.
they're growth or undervalued
Mhm.
or we'll say spreading profit. Is it kind of hard and true that the growth type of companies aren't really the ones to give out dividends and you want to look towards more of the undervalued areas? I'm not sure if you could give any examples or if it's just kind of whatever is happening in the market may impact these companies and they may not.
Yeah, it's kind of a combination of all that. I mean, it just kind of boils down to what, kind of what people are looking for. I mean, one other thing to kind of keep in mind here is what the Fed is doing with rates. Let's say if the Fed keeps cutting rates, that actually makes some areas even more attractive. Let's say utilities that generally have a good dividends. The Fed is going to cut rates, and then that means just treasuries are going to go lower. If you're looking for that income, then that actually is good not only for the dividends, but also for maybe some capital appreciation on high dividend areas. Like utilities are good, financials tend to pay good dividends. And yeah, it just kind of depends what you're looking for.
Got it. Well, all of these points were really helpful. Thanks for joining us on the program today, Robert.
Okay, well, thank you so much. Have a good day.
Sure. So, as always, listeners can learn more about an array of financial topics for free at interactivebrokers.com/campus. Follow us on your favorite podcast network and feel free to leave us a rating or review. Thanks for listening, everyone.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Interactive Brokers does not provide tax advice, does not make representations regarding the particular tax consequences of any investments, and cannot assist clients with tax filings. Investors should consult with their tax professional about the tax implications of any investment.